Welcome back, fail-safe investors, and today's topics is ETFs. So if you were at any point looking at mutual funds and you probably didn't have the money, or you didn't like the expense ratio, or you didn't have the minimum investment amount, another option would be ETFs. So ETFs are kind of modeled like mutual funds, but there are some slight differences. So with an ETF, you, instead of buying them through a broker, you can buy an ETF on a normal exchange, like the New York Stock Exchange or any other exchange that you buy your stock on. And so it's bought and sold like a stock. So since a mutual fund, you can only buy, since it's open-ended, you can only buy a mutual fund at the beginning of the trade or at the end of the trading day. With the ETF, you can buy or sell an ETF like a stock, like meaning any point through the day. So that's good and bad, because even though you can liquidate your money quickly, if a lot of people sell out of the ETF at once, pretty much you're losing money quickly. So when the stock market crash and ETFs become nothing, or people start selling out of ETFs, yeah, you can lose your money overnight or within one day, within one trading day. So with the ETF, since it's passively managed and not actively managed, like an index fund and a mutual fund, it has an expense ratio, but the expense ratio for an ETF is a lot lower than a mutual fund since it's passively managed. So you can find an ETF with an expense ratio of like 0.7. So if you have $100 in this ETF, you're only spending 70 cents a year to pretty much manage that ETF. But you can also have ETFs in any sector. Like a mutual fund, you can find ETFs in sectors, you can find bond ETFs. It's pretty much like a mutual fund, pretty much to say the least. So you can find, if you want to get into bonds and you can't afford those $1,000 payment for a bond or $1,000 up front for a bond, you can find an ETF for cheap or affordable, relatively affordable. Buy an ETF, there you go, you have a bond portfolio. All right, so some of the pros with investing in an ETF would be, it's an easy way to diversify your portfolio. You have low expense ratio compared to a mutual fund. And also you can buy and sell an ETF anytime during the trading day. But that's kind of a double-edged sword, because that's also the con, that you can buy and sell anytime during the trading day. That makes the price of ETFs volatile, meaning they can fall like that. And another con with the ETF might be, since it's not actively managed like a mutual fund, the odds of you beating any indexes or any markets or the market as a whole is it's slim to none pretty much, because it's just tracking the market. So it's not gonna beat the market because there's no one actively managing it like a mutual fund. And hopefully I've given you enough information to have a fail-safe investment in ETFs. I'll leave the link in the description for how to diversify a portfolio, or I have a info tab right here that says how to diversify your portfolio. My name is Terry. Thank you for watching my videos on Fail Safe Wealth. Let's do it.